I've listened with amusement to all of the commentary talking about the recent increase in the longer-term interest rates. Lots of people are making a big deal out of it. They are saying things like the 10-year Treasury has gone from 1.7% to 2.2%, and that's a 29% increase in rates in less than half a year. Well, that's certainly one way to look at it, and it's the way to present it if you want to get people's attention. But let's put things into perspective. Let's ask ourselves just how significant this move really is. On a one-year chart, it certainly looks impressive. Those who put any faith in technical analysis are apt to point to the higher high and the higher low as an indication of a trend change. But let's look at the bigger picture. I happen to believe that most of us private investors can really only take advantage of long-term trends because the short-term trends are always front-run by the professionals. Here's a 10-year note interest rate going back multiple decades. Clearly, there are short-term fluctuations in the 10-year rate, but the more interesting feature of the graph is that the much more meaningful changes take a very long time to develop. If you focus your attention on the right-hand side of the chart, you can see the change that has been dubbed by the media sensationalists as a sell-off. You can see it, can't you? No? Okay, let me point it out to you. There's the sell-off. Doesn't look very important in the grand scheme of things, though, does it? That's not to say that the rate can't rise some more. After all, there is quite a bit of short-term cyclical behavior in this data, and this short-term trend could be part of one of those cycles. So how will we know when we need to be concerned about a genuine change in the long-term interest rate trend? Well, here's one way. I don't personally put much stock in technical analysis, but I do acknowledge long-term trend lines as a way to distinguish signal from noise. As we can see, rates would have to rise considerably in order to indicate that a fundamental change in direction in long-term rates is upon us. Until that happens, we must assume that the long-term interest rates will be low for quite some time. I see no reason for rates to increase on the long end. Remember, we live in a world of fiat money and fractional reserve banking. That said, the supply of money and credit has no upper bound, and so rising rates should not be caused by a shortage of money. If there was a borrower in good standing who is willing to borrow, then there will always be a lender who will make the quote-unquote money available. Therefore, long-term interest rates must be assumed to be set by the rate at which consumers and industry are willing to borrow. And as we've discussed, the consumer is maxed out in terms of borrowing, and industry is retrenching as a result of high production costs and shrinking demand for finished product. Rather than rehash those details, let's see how this all ties into the second topic that I'd like to discuss today, which is the rumblings of a move towards being a cashless society. As we've discussed in the past, the banking industry doesn't really care about the absolute level of interest rates so much as they want to make sure that there is a healthy spread between short-term rates and long-term rates. The quote-unquote money that they deal with has a cost to them, and that cost is the short-term rate. This sets the interest rate that they pay depositors and is the rate most readily influenced by the Federal Reserve. The bank's revenue is generated on the long end. The money they lend out is at a much higher rate, and the bank gets to pocket the rate differential. Typically, the differential is a couple of percentage points. What makes today's situation unique is that the short-term rate is against the zero bound. If longer-term rates continue to go down due to lack of interest in borrowing, then the banks will have trouble making the easy money that they've grown accustomed to. The Federal Reserve, representing the cartel of banks, is not going to increase short-term rates unless interest rates on the long end trend upwards. To do so would be to choke off the profits of the banking system, and that's not what they want to do. This is why the minutes released the other day indicate that they are not going to raise rates in June. I'd be surprised if they raised them any time in the next couple of years. And it's not because they're interested in slowing down the economy. It's not because they want to be fair to savers. It's simply because they do not want to choke off the bank's profits. Plain and simple. But here's the problem. What if long-term rates go down further from here? Remember the last chart where I showed you that the long-term trend is clearly still down? Well, that means that banking profits will contract naturally unless the Fed does something. But what can it do? Can it lower short-term rates below zero? Possibly. Banks could certainly start charging depositors a fee for safeguarding their paper scrip. But if that fee gets to be too high, then people will probably opt to simply safeguard their cash themselves. This would stress the system, much like the bank runs in the early 30s stressed the system. This time, instead of the withdrawal of gold crashing the banking system, it would be the withdrawal of cash. And this is why we are hearing trial balloons floated about moving towards a cashless society. I think the move is inevitable because the banking system will be protected at all costs. Now, I'm not saying that I like it. I don't. I'm just calling it as I see it. Such a move towards a cashless society would prevent capital from exiting the banking system. Because someone would always own those banking credits, then there will always be someone to charge. Of course, the danger really comes when nobody is interested in being paid with bank credits that are guaranteed to be slowly eroded over time. People will simply seek another means by which to safeguard their wealth. And a time will come when their wealth goes into hiding, not to be exposed to the penalties imposed by the system, and only coming out in a situation where value is bid for value. This is the time when the mined value on tangible wealth will increase considerably as the mined value placed upon financial wealth diminishes. It's funny when you think about it, but the elimination of cash may be the catalyst that inspires the population to rediscover money.